parents. I am Alvin, your moderator for today. And with me, we have Mr. Tan Ming Han, Mr. Raymond Jing, Mr. James Ying, and Mr. Tan Gan Leong sitting with me here today to discuss some of the key developments and major outlook of some that will be happening around the world in 2024. So to start off this panel discussion, let's start off with one very simple, easy question. So, what has surprises you in 2023? And would there be a change in 2024? Can we start off with Mr. Tan Ming Han?
I think the surprise that we had in 2023 was, despite central banks having very restrictive interest rate environment, there was huge outperformance in terms of some of the tech names, especially in the NASDAQ, the Philadelphia Semiconductor Index, and also in this part of the region in Asia, where we saw Taiwan, Korea outperform massively. So this is something that surprised us, especially when you have restrictive interest rate environment, corporates still are able to borrow money and invest and grow their businesses. And hence, I think this is some catalyst which is very evident in going into 2024, where interest rates are going to come off and you're going to have a cheaper cost of funds to actually invest for the longer term.
Okay, next, can I have Mr. Raymond?
Actually, because we focus on China, so I'll talk more about China. So in last year, the biggest surprise comes from the fiscal, policies in China, because we originally thought it should be like expansion in fiscal expenditures in China, so that will boost the performance of the economy as well as the market. But actually, we saw that in last year, the central government, they control the financing power of the provincial level in China, try to control the overall leverage ratio, even though that investors as well as the enterprises, they have very optimistic expectations on fiscal policies. So we saw a contraction in finance rather than a expansion. So that led poor performance in economy as well as the earnings growth in China market. But in this year, I think that will be different, because we think a higher target for the growth in China, it requires the government to do more to achieve that. So I think for the fiscal expenditure as well as the deficit ratio should be lifted to achieve that ambitious goal. Yeah.
Okay, so maybe on a global perspective, can I have Mr. James?
Yeah, sure. In terms of surprises, I think one of the biggest ones that we have seen, I think would mirror what Raymond was talking about, is in China. I think everyone was expecting the post-COVID reopening to be the growth engine that we sorely needed going after 2022. But really, after what we've seen, how the real estate industry and the issues that you're dealing with has impacted consumer psychology and confidence, that has not really materialized in the way or in a fashion that we were hoping that it would. Going into 2024, we do think there are some early signs of consumer confidence bottoming out in late last year, and there could be some signs of improvement. We have seen some polls that have seen an improvement in numbers and figures. But at the same time, we do think that the real estate industry is going to take quite some time to sort itself out one way or another, and we think that that is going to also impact the consumer-oriented economy, the domestic demand, and that is going to take some time for it to come back the way that it did pre-pandemic.
Okay, thank you. So maybe on back to our local market. So what is your what has surprises you the most in 2023, Mr. Tan Gan Leong, and what will there be a change in 2024?
I think so. Basically, last year when I spoke to quite a fair bit of my peers, the concern was a recession was coming, considering how fast interest rates have gone up in 2023. I think consensus, most economists was talking about hard landing, talking about, there will be a recession. But nevertheless, I think as of today, where we stand today, no one's talking about hard landing anymore. I think the consensus right now is we're going to have a smooth landing, right? A soft landing. So I think the fear here is for us that, what we fear in 2024 in Malaysia would be the subsidy rationalization. You see, previously, we didn't have an inflation problem. So when we didn't need to raise interest rate like our other Asian neighbors when America was increasing interest rates. But this year, when, if our government goes through with the subsidy rationalization, and if a lot of businesses actually take disadvantage to increase prices, we may start to see an inflation problem. And if the inflation problems start to kick in and interest rates start to go up, and if economy starts to slow down, then we will have an issue. So I think that's the biggest risk that I see and my fear for this year.
I see, thank you. So maybe the next question will be more directed to Mr. James here. So first of all, will it be like in the past, right, especially in 2023, the rally was mostly driven by the large cap names like the Magnificent Seven, the names, right? So will it be the same 7 names, or we will start seeing addition names to that in this year?
So I think we would likely see a more diversified trend in terms of upside going into 2024 compared to 23. I think 2023, the Magnificent Seven names were their strong performance was partially also affected by what happened in 2022. So if you actually take a look from a 2-year perspective, they are essentially close to even, maybe some upside, maybe some downside there. But we've actually seen signs where in the second half of 2023, where that market leadership has started to become less concentrated, where we saw 75% of the positive contribution coming from the Magnificent Seven for S&P 500 in the first half, but that number has already gone down to about, I'd say, 50 to 55% in the second half. We think that trend is going to continue. So all in all, we think it will be more diversified in the next, at least the 6-9 months ahead.
I see. So, and then the next question we have here is, what could be the theme for 2024? Given that in 2023, our team was mostly like, at the start of the year, we have the AI team that caused the rally, and then towards the middle, towards the end, and some the optimism over rate cuts, right? So, what will be the theme in 2024 that will drive market, Mr. James?
As much as this answer may be cliche, I think rate cuts are going to be really the main determinant in terms of short-term share price performance. If you're just strictly looking at 2024, I think the market in recent years has become very dominant in terms of impact, determined by macro direction. So I think that any rate cut announcement, any softening in employment figures, labor market, especially in the US, consumer spending, GDP growth, I think those are really going to be main determinants of what will happen to the market in 2024. So I wouldn't say really that's a theme. I mean, if you want to call that a theme, that has been going on for the past couple of years at this point. But we do think that 2023, that was very much AI dominated, large mega cap dominated. That was the hype. But I think that that has largely been priced in, especially by some of the Magnificent Seven companies and some of the also tech related names as well. So going forward, I think macro policy is also in US, China, Japan also. Those are going to be more of the main drivers and really the main theme for market direction in 2024.
See. So may I get Mr. Tan Ming Han, what will be the main theme for Asia in your case?
I think this year it's going to be very interesting where we go through multiple transitions, right? So I think in Asia we have a couple of number of elections going to happen. And I think these key markets such as India, South Korea, Taiwan, Indonesia will have their general elections. So I think there will be interesting times where, where there's a transition of policy continuing from the incumbent government to the next. And this will actually spur in terms of whether the government is actually focused on development and in terms of reforming the economy. At the same time, don't forget China, because China, I think here everyone has been quite sad to see the disappointment coming out, whether they reopen after the COVID lockdown, which was actually slower than expected. The consumption story, which actually took a dive following the property issues. So I think China's government has actually put in significant measures to actually address this property struggle that they're having. And hopefully, I think in 2024, we see the Chinese economy able to transit from this dual circulation track, where they focus more on industrialization, advanced manufacturing, and at the same time addressing the property slowness. And hopefully that will actually translate into consumption patterns returning for the market.
Okay, so Mr. Raymond, do you have anything to add on in the case of China?
Actually, the other peers, they talk about some themes because last year, AI actually dominated not only in US but also in China. So when we look into 2024, we can anticipate a more broad opportunities or systematic opportunities in China market. So as I mentioned, besides AI, we can find more opportunities, for example, within consumption, within healthcare. Actually, under such kind of a trough sentiment, if things getting better, I think for China market should be like a systematic come up. Yeah.
Okay, thank you. So it looks like there will be a lot of headwinds going on in 2024, especially for major elections for a lot of countries as well, for US also. So how will this all affect the local Malaysian market, Mr. Tan Gan Leong? Are we insulated from all of this?
Sadly, Malaysian market have been quite independent from globally. When markets are doing well everywhere, we are not doing well at all. So in a way, yes, we have been seen as a very defensive market in the past, whereby when there's a sell-off elsewhere, our market actually hold up significantly better. But from our perspective, domestically, we have our risks, which I highlighted earlier just now, where this subsidy rationalization were to happen. It's something new that they're trying to push through, and our current government is, trying to fix its current fiscal position. So if that's the case, then that I would say that would be the biggest risk that I see this year. And as for themes, I think earlier I did mention the themes that I like. I like oil and gas. I think in that area, by default, no one really like oil anymore, right? So a lot of funds who are staying away because of ESG concerns. So hence why today you are seeing oil stocks trading at single-digit PE. Hence, we think that, even if there's a sell-off globally, I think that, these companies will still do well because, the main customer, Petronas, have been putting on hold on this maintenance work for too long. So they are starting to have issues, especially if Malaysian market, if the Malaysian government needs the money, they need to continue to produce oil at high volumes. So they cannot afford to put on hold all this maintenance. So I think that, for these companies that we invest in, earnings will still do well. But nevertheless, we are still stock pickers by nature. So, we think that there will always be pocket of opportunities within the Malaysian investment space. Even when you look at during the years of crisis, there's always 10 stocks that do, outperform the whole market and still generate positive returns. For us, our job is to look for that 10 stocks to invest in.
So stock selection will be the key in 2024, right? So, okay, so the next question. So geopolitical tensions has been around for a few years already, and it doesn't seems that it will go away in 2024. Especially now we have U.S. and China tensions between both of these major powerhouses has been brewing. So considering this, how does it affect first the outlook for U.S.? May I get Mr. James?
I think since 2024, I think one of the key things to think about is that it is an election year, right? I think that, in a sense, would limit the amount of drama, so to speak, that would go on from a geopolitical standpoint. Obviously, if something happens between China and Taiwan, which is obviously the elephant in the room, so to speak, from a geopolitical standpoint, that would change the whole calculus completely. But I think 2024 typically, much like previous election cycles, they don't tend to be very volatile from a market's perspective. Previous election cycles tend to generate positive returns for in the markets in the U.S. at least. But in terms of geopolitical tensions, obviously with the two candidates having quite a different policy in terms of their stance towards Ukraine, Russia, obviously, that could be, that could be quite volatile in terms of how US's position and standing would change, depending on who gets elected, and going into the cycle, who would be the most likely candidate to lead the country for the next 4 years.
I see. So coming into China, how will this US-China tensions would affect the case of China?
Actually, yeah, this year should have like Taiwan re-election, like U.S. re-election. So actually, it's still a quite macro year for us. Usually, such kind of the re-election will have some impact on the risk appetite on China market. But actually, our last like 3 years decoupling, right, by U.S. Actually, we have already experienced more severe conditions than that. So I don't think there are any chance that we will see a major change between China and the U.S. relationship. So I don't think there will be any surprise. So and from the valuation level, I think the poor performance in the last 3 years have fully priced in such kind of the raise or tailwinds as well as the possible revise down of earnings growth. So for China, I think based on such low sentiment, anything change, no matter bad or good, I think should be a good thing for China market, especially for those investors who suffer from the market last 3 years. And also, for last 3 years, one major change from, due to such kind of tensions, is the restructure of the export or trade partners of China, right? As I mentioned, even though U.S. tried to decouple China, but we saw that China have more, business with Asian countries, developing market as well, Russia as African countries. So actually, such kind of decoupling actually benefit these countries or emerging markets a lot. So I think such kind of, transition should last and also will benefit for China as well as its partners in the long run. Yeah.
I see. So, Mr. Tan Ming-Han, do you have anything to add on, or you have different opinions on this, on the case for China?
I do concur with our panel here, and I think the gist of China here in the context of the trade tensions with the U.S., even though whoever wins the elections in the U.S., the relationship is going to be hot and cold, hot and cold. They meet up in San Francisco, but they go back to their country, and then they make their own policy measures again. And I think they are focused on creating their own domestic champions in the country, right? So U.S. wants to safeguard their own manufacturing capabilities, while at the same time China wants to do the same thing. But over the course since the trade tensions, since the time of Donald Trump's presidency, I think we have already seen that China has been able to adapt and create national champions within their country. So clear example is Huawei. Despite the sanctions imposed on Huawei, just recently the announcement of their latest handset, which has the Kirin chips, are superb, and they are equivalent to the speeds of what you have in your Apple iPhones. So I think this is a thesis that China, despite of all these trade headwinds, China is able to innovate internally and become stronger. So I think we shouldn't write off China. I think China going forward will continue to innovate and focus on the innovation. And perhaps maybe one day we will see some of these products in the West, which they will be thankful for. In terms of now, we are really reliant on a lot of Western technologies, right? So going forward, we'll probably be driving an EV from China instead of an American car or a European continental car, right? So I think China's products are going to be pretty dominant, as you can see that the way they are transiting in terms of innovation.
Yeah, thank you. So in fact, China's BYD has been very popular in Malaysia also in terms of EV cars. So just now, Mr. Raymond mentioned that there will be a decoupling from China benefiting ASEAN countries. So can I get Mr. Tan Gan Leong, what is Malaysia's position in this?
So I think I did highlighted earlier in my presentation that I think Malaysia can capitalize on this geopolitical tension that we are facing today between US and China. I don't think it's going to improve anytime soon, even though whether it's the Democrats or Republican nominee were to win the presidential election. I think that the Americans itself, they all now have this sort of resentment towards the Chinese. So that's not going to change. Narrative is not going to change. So for us, Malaysia, we are too small to make a noise, to make a difference. But what we can do is we can capitalize on it. You know, with the weaker ringgit, young demographics, we can actually, you know, attract these investors, you know, to invest in Malaysia. Especially, we are starting to see a lot of activities in Penang. You know, we are a very big semiconductor hub, and we think that, you know, we just need to take a little bit of market share from China. That would benefit us greatly.
Thank you, Mr. Tan. So one question here is directed to Mr. Tan Ming Han. So it will be, other than China, what are the opportunity lies between in Asia?
I think if we look closely at the demographics of Asia, right, you will see two big key markets, which is China and India. And I think India here, since the President Modi, since 2014, I think he implemented the Made in India agenda. It has been very successful. Secondly, also, the penetration rate for payments, where they actually using the unified payments system in India itself, was able to reach out to the rural areas, and people are able to use handphones to do transactions in India. So that's a significant game changer for the Indian economy, because transactions now are all seamlessly done through the handphone. And I think going forward, India is benefiting from this transition between China plus one. All the investors, corporate investors that we did a survey in our Asia 2.0 study, which you can get it available on our eSpring website, shows that corporates are looking at India to focus their investments there. It's because India has knowledge workers, a cheap labor force, and they are becoming a significant manufacturing hub for a lot of MNCs. So I think going forward, even though India, despite the valuations, which is currently very expensive, we see there's multiple catalysts for the marketplace. Yeah.
Okay, thank you. So the next question we have here is towards Mr. Raymond. So I believe our audience, many of our audience sitting down here have at least some or, if not many, a lot of exposures towards China. And you already know that China has been one of the worst performing market in 2023. And we have heard a lot of people saying that China, people in China wants to lie flat. They call it 躺平. And now, and rich people are leaving China and all, right? So, and a lot of us here, we actually do not have that. We are not living in China, so we don't know what is actually happening in China. Is it true? Because based on your local expertise.
Actually, I want to give you an example for the opposite views from us, because most of recent days, actually, tourism in China is booming, especially in the northern provinces, such as Heilongjiang province and other two provinces. Actually, we saw, more and more people, they like to travel a lot domestically, as the my peer said, and actually that represent the activities in China among the citizens becoming more and more dynamic and active. So actually that can, I believe that is opposite examples to say if they all just lie down, actually they have no such kind of intentions to go around or to do some, work to enjoy their lives. Okay, it's just like the Japan in between like 1990s to 2010. Actually, we saw that more and more Chinese people, they began to go out, began to travel, began to consume. So I believe that after we saw the data or the manufacturing sector recover in this year, we say more and more citizens will have the confidence, more confidence than previous years during the COVID zero policy time. So actually, we believe that the prospect of or promising future will be shown up in 2024. And also, actually, Chinese government, they did do a lot of things to do the transition of the model of the growth of the economy. For example, like 3 years ago, actually, the government, they rely on the land finance. But actually, since this year, actually, the Chinese government want to boost the data finance. Okay, so actually, we have already seen such kind of change. So that means the quality of China's economy will improve a lot. So that will lead a different kind of picture for China's economy as well as the China citizens, feeling in next few years. Yeah.
Okay, so one question here to Mr. Tan Gan Leong. So, because from what I know, you're also managing an Asian fund. So, can I get your views on China?
So basically, I think the issue right now in China is because there's a deflationary environment. So I think recently we saw a sell-off in China because the inflation numbers that came out was very disappointing. So in a deflationary environment, it's very difficult for the government to stimulate the economy because in those environments, people will always put on hold purchases. You see, if you think that the car prices will come down 6 months down the road, you won't buy the car today. You'll wait 6 months down the road. When everyone is putting on hold purchases, what happened? The economy starts to slow down. Businesses slow down. And when business slow down, what they do? They cut costs. They retrench. So then, by default, when you lose your job, when your salary gets cut, you're not going to go out spending more money. So even when the prices were to come down, you're not going to buy. And then prices are anticipated to come down even further. So it's a very vicious cycle, if you ask me. So I think, first of all, we need to look at the improvement in the PPI numbers first. And if we start to see improvement there, I think that another issue is also the Chinese government is a bit different from the American government. The American government do things in a very big way. They spend, the Feds will pump prime big time, right? The Chinese government, they will introduce policies, but small policies, they'll try to adapt to the market. They do small policies that actually try to fix small problems here and there, but it's not something that will shake the market. You see, it will not suddenly improve confidence like, oh, we're going to go out in a big way. So I think that's also another issue that that I think is facing. But then on a valuation perspective, it's extremely attractive. So in a way, you can say that a lot of bad news have already been priced in today's valuation. So maybe if you have time to wait, if you can hold on to your investments, then I would think that it could be a relatively attractive investment opportunity.
Thank you, Mr. Tan, for highlighting some of the key concerns that is happening in China right now. So finally, I like what Mr. James said just now, that we are in a very different era and where higher inflation, higher interest rate is likely to be the new norm. So how does this affect the investment case for the global markets? Can I get Mr. James?
If you're looking at how you can approach global markets, I think I also mentioned earlier in my presentation is that I think between 08, 09 and let's say 2021, you could be in the market and be rewarded. As long as you're in the market, most likely you are going to see positive gains. Now, the degree of that would depend on some certain sectors, which region you were really invested in, but frankly, it was not very punishing if you get it wrong. But I think what we've seen in the past 3 years now, or 2.5 years, is a reversal of that, or at least a change in that. And I think a lot of investors in the market don't really remember what it was like before 08, 09, where you can actually have quite a serious consequence, or at least quite serious drawdown if you get things wrong. And I think that we are slowly reverting back to that type of regime. So higher rates, more sticky inflation, that is going to really differentiate between, as I mentioned, some of the more high quality companies, some of the better businesses that are able to weather the storm a bit better. You've seen a lot of companies over the past couple of years really suffer because they've borrowed too much in the past 10 to 15 years, and that has really come back to bite them. So I do think that that trend is going to continue. So in terms of how we approach the global markets, rather than focusing on specific regions, even though there are specific regions that are poised to do better than others, even in those individual economies, I think investors should exercise some caution in what companies they choose and really decipher between what would classify as a good and high quality company between ones that are not.
Thank you. But as we know, also, most of this high inflation, high interest rate doesn't apply to many of the major countries within Asian region. So may I get Mr. Tan Ming Han to address this on how does the high interest rate, higher for longer interest rate era in the developed markets affect the investment case for Asian equities?
Okay, so I think the era of high interest rates is actually probably coming to an end. They're assuming that inflation is under control, especially in the US now, where you see the PCE indicator has actually come off quite a fair bit, although it's still above the 2% mark, which is widely tracked by the Fed. The only thing that I think the Fed is actually very cognizant is that the jobs market is still very strong. And hence, I think once you see weaknesses in the jobs market, wage growth and payroll data coming out from the US, the incremental delta where there's a change would see a significant outflow of money coming out from developed markets into Asia, where we think that Asia actually has a better growth profile. If you compare the growth profile of the States, which is close to this year, I think forecasted at a +1% versus Asia at 4.5%, 5%, I think it's attractive enough to draw those money from developed markets, especially from US.
Okay, thank you. So before we end, one very, very final questions to ask all our panelists today is, in light of the macro environment in 2024, how should investors position themselves? Can you give me like a percentage on how would you recommend investors to allocate in both equities and fixed income? So may I start first with Mr. Tan Ming Han?
As an investor, I think in your context of your basket, how much to allocate for equities, fixed income, or even money markets, ideally it depends on your risk profile. So your risk profile, if you are high risk, high return, I would suggest maybe 60-80% in equities, 20% in fixed income and money market. And ultimately also it depends on your risk appetite and whether you are a passive income investor. So even though between the 80% basket, you can still allocate into dividend yield stocks if you are not a high risk taker. If you are a high risk taker, you could actually allocate more into growth stocks, which is leveraged in this region mostly to the tech. While at the same time, the 20% into fixed income and money market, assuming you have a very low risk of tolerance, maybe your usual FD products, or you have money to invest in the US, buy a fixed treasury at 4%. That's good yield, where especially the whole global environment is actually slowing. So this is how you allocate. And I suspect most of the money should still stay with equities because ultimately equities is going to give you a higher return.
Would it be different for Mr. Raymond?
Actually, for a China market, I think it's an easy question because if you look at the dividend payout ratio for China Asia market, is already as high as 3.5%. But if you look at the 10-year treasury bond yield in China, was only like 2.5%. And we will see more interest rate cut in China as well as US this year. So I think for the portfolio investors, they focus on China as a class. It's quite easier that if I am an investor, I should put majority of the portfolio in the equity rather than fixed income. Even though we think because the real interest rate will go down, both asset class will enjoy quite good, absolute return in my point of view in this year.
Okay, so any different views, Mr. James, in the context of global?
Unfortunately, no. I think I would mirror what the two gentlemen have said on my right. I do think that with rate cuts on the horizon, both asset classes are quite well positioned to do well in 2024 and at least over the next 12 months. We do think that in terms of the upside potential and the overall return potential, equities do present a better type of opportunity. So I would say the classic 60-40 would be a good position. Obviously, that was not the case in some of the previous years that we've experienced, but we do think that if investors have the risk appetite and is in a suitable risk profile, we do think that putting more of your assets in equities would be probably more beneficial to your overall return moving forward.
Anything to add on, Mr. Tan Gan Leong?
Actually, I do agree with our fellow panelists here. Essentially, it depends on the risk appetite of the investors. And I mean, the rule of thumb have always been you take 100, you minus your age, and that's your equity exposure. So if you're 40, then 60% in equities. So obviously, if you have a longer investment horizon, yes, equities do generate higher returns than other asset classes. But essentially, it's always case-to-case basis, considering your risk appetite. So I do agree with all the gentlemen over here.
Okay, so thank you. So it looks like equities will still be performing in 2024. It still will be the peak over fixed income. So, okay, so at last, I would like to thank all the panelists today to share some of their ideas, insights on what will move the markets in the coming months to year ahead. So once again, thank you all.